Holy smokes, 69% off flash sale going on now through Valentine's Day? Dang, may as well take advantage of that because that is a deal. Link down below. And remember, that's a flash sale. That's an investment in yourself for programs on building your wealth. And since these programs are an educational expense and tax season is coming up, remember, these programs could be a perfect tax deduction for you. Check with your CPA, but investing in yourself or your business could be the perfect tax deduction for you. Take advantage of that 69% off flash sale before it's gone. Now we gotta give some credence to the Bears. And of course, every time I give the Bears some credit and show reports from the Bears, like what we're gonna talk about here, whether it's Mike Wilson from Morgan Stanley, guess what position he's taking? He's a Bear. And we're gonna go look at what Bloomberg economists are forecasting. We're gonna look at some of their models. We'll look at transitory Goldilocks, and we'll look at the vibe session. We'll have a lot to talk about, but I have to first disclaim, anytime I make a bearish video, there are losers that, of course, we're not going to mention by name, but there are these losers who like to take screenshots of my channel, and they're like, look at Kevin. One day he's bullish, one day he's bearish. And it's like, you're just another idiot who doesn't watch to the end of the video. So, and honestly, not even through the end of the video. I mean, I honestly, when I cover the bearish stuff, I'm like, look, I'm covering this, but obviously I'm a bull, and here's my take on it, right? Like, it's like, I don't know. I think sometimes people are just like miserable in their own lives and they have to find a reason to hate on someone. It's like, I think I've been pretty damn consistent about my Nike swoosh thesis, right? I want to make that clear up front, okay? You don't even have to make it to the end of the video. I think I'm very clear that while we had that V-shaped recovery and buy the dip was great in the COVID pandemic, this is probably an elongated Nike swoosh. We're going to have a lot of ups and downs and plenty of buy the dip opportunities and no massive panic rush to be all in. I've been saying for a bit, I don't think 10 to 15% cash on the sidelines and no margin is a bad idea. So those are my takes. But I don't know. Those are the same people who try to allege things like, oh, well, Kevin was selling while he was telling you to buy. That never happened. If I tell you I'm buying, that's what I'm doing. I would never do that. First of all, I'd get in trouble by the SEC. I'm SEC regulated, folks, okay? That would be terrible. Now, I might change my mind very quickly like I did in January of 2020, and I get that. Like, in fairness, it went fast, okay? It went from me buying like January 18th to like January 21st. Oh, shit. Like, I finally put the pieces of the puzzle together, right? Which ended up being the right call to flip, right? Thank God. But anyway. So let's talk about some of the drama we've got here. So Bloomberg Economics suggesting that Powell's preferred recession indicator skyrocketed in January. Now, from a bearish point of view, that means, oh crap, we're going into a recession. From a bullish point of view, that means, hell yeah, Jerome Powell's preferred measure went dirty. That means he's going to spank us less hard. Anyway, so then you've got the indicators. So what they are basically is you have three potential yield curves to look at. You have the 2s and 10s, which is the 2-year, 10-year. You've got the 3 and 10, which is not the 3-year, okay? It's the 3-month 10-year. And then you have the 3-month, 18-month yield curve model. And Powell's preferred is the 3-month, 18-month model. I'll throw that up on screen right here, and I'll keep myself off of it so you can actually see it, so I'm not blocking it. So this chart is honestly a garbage chart. Someone sent this to me, and I'm like, dude, this is such a complicated looking chart. But anyway, on the far right, you can basically see Powell's line goes up. Okay, it's the deepest inverted yield curve we've seen with the Powell preferred indicator, which suggests recession coming, right? The 2's 10 is pretty high. The 3-10 obviously pretty inverted as well, but nowhere near as bad as Powell's. Powie, good old Powie. Then you've got the Bloomberg Economics 12-month recession model, and it's basically at 100%. Which the last time it was at 100% was in 2019, which obviously then we got the COVID pandemic. It was at 100% in 2006 and 7, which obviously we got the Great Recession. It was at 100% in the dot-com era, which obviously we got the dot-com bubble. But we did have a false indicator in 1998 where you actually had the indicator suggest we had a 100% probability of going into a recession within the next 12 months. and it was actually wrong. We didn't end up going into a recession within the next 12 months. We ended up going into nothing. we were fine in 1999, and it really wasn't until a year later in 2000 that we started seeing, it looks like we might be heading into a recession, and then sure enough we did by like 2000, 2001, 2003, obviously a recessionary era. So it shows you that these indicators are not perfect, right? They have false starts, and that's okay, and that's to be expected that these indicators have false starts. But I think one of the things that we also have to be very clear about when we look at these models is that they're not necessarily telling us we're going to hell, right? Like, think about that for a moment. In fact, one of my, by the way, and this is sort of a tangent, one of my favorite Warren Buffett quotes is "Tell them to go to hell tomorrow." Very good tool, by the way, for if you're ever in business. Tell them to go to hell tomorrow. Like, relax your expectations. But anyway, this the idea that, we're definitely going to hit a recession. Okay, fine. So the models say we're definitely going to hit a recession. How bad's the recession going to be? Well, I don't know. Well, sure, the models don't really tell you how bad it's going to be. Now, you can try to suggest when or how bad the models are going to be, and the way you do that is you kind of look at, okay, well, if we're going to see a recession, how much is the Federal Reserve going to have to cut? And if you line that up on the charts, right now the Fed's looking at potentially cutting in the event of a recession by 5.25%, because that's how deep the inverted yield curve is. And if you stack that up with a linear regression model to what's historically happened, that's what you get. You get, basically 525 basis points worth of cuts, which is wild. But maybe that's exactly what we end up getting over the next few years. So it could end up playing out, but it could also be that the recession we see is like, oh no, we're down 0.1% in GDP. Like, okay, that's pretty benign, right? And that's actually what some of the high frequency signals are showing us as well. This is sort of like some of the mortgage pre-approvals. You're actually seeing an increase, suggesting, okay, maybe people are still resilient to buy, which is really fascinating. You're seeing, sure, manufacturing and industrial is losing steam, but you're seeing services consumption still pretty dang resilient. You look at the cruise lines, you look at the airlines, like, people are still spending. You've got American Express saying people are spending through the recession or whatever it may be. Consumer demand generally stable. I like this one. Bookings at OpenTable as of January are actually up at the start of 2023. Now, it's possible that if they're comparing to 2022, you have to remember, you had Omicron in 2022, and nobody was going out to restaurants in 2022. That was pretty crazy. But then you've got, consumers still traveling. That's a big deal. The Beige Book shows the same thing. It's not just earnings, but it's the Federal Reserve's Beige Book showing that consumers are still traveling. And yeah, you've got a leveling off of job listings and potentially job openings, but the JOLTS suggested job openings actually open. Indeed.com is telling us they're leveling off, but JOLTS is saying, oh, they're still going up. At the same time as you've got more of this consumer travel demand, you actually have the number of oil rigs down 4.5% since December, at the same time as the Chinese reopening potentially pushing oil demand up. And you've got a lot of pessimism levels at households, like consumer and business sentiment is pretty poor. The gap between where consumers feel right now and what they expect for the future is huge. It's the largest that we've seen since the 2008 recession. And then, of course, you got people like, Morgan Stanley's Mike Wilson basically saying, look, all of this combined is going to turn into a very ugly earnings season. He's, of course, our staunch bear. He says, look, sure, we're seeing rates go higher, but the market's just not pricing in what higher for longer actually means. And what's going to happen is when those bad earnings come in, markets are going to sell off, and you're going to see broad declines on the indices, because right now Morgan Stanley's Mike Wilson says, look, prices are just straight up disconnected from reality. And maybe tomorrow's CPI report will end up being a reality check, he calls it. Of course, this is also leading to a lot of calls that, hey, we're going to end up going higher for longer. And by going higher for longer, the market's basically not pricing in that EPS is going to get screwed. Now, that's Mike Wilson. He's the bear at Morgan Stanley. Interestingly, though, not everyone at Morgan Stanley actually agrees with Mike Wilson. So what do you have over here? The no landing. Let's talk about that. Right after I mention I need to take a sip of coffee. Bet you weren't expecting that one. Thank you. All right, so what do we have over here? Before we look at that, take a look on screen here. We've got the largest flash sale on a percentage basis that we've ever had, 69% for any of the programs on building your wealth. And this includes the stocks course, real estate courses, income courses, and even the shadowing experience, which is really incredible. Now, which one's right for you? Well, I'll tell you this. Most people get started with either the Stocks and Psychology of Money group or the Zero to Millionaire Real Estate Investing course. In fact, a lot of people use these flash sales to bundle up between the both of these programs. This is how you're getting great pricing on both of these together. Now, the Stocks and Psych group is coming with a new trading challenge where my team and I work together to take all of the research that we do and then think of what we think as the best and most likely to succeed trades. And so we'll be posting those regularly for those of you in the Stocks and Psychology of Money group starting this week, which is very exciting. You also get updates and insights into my personal moves. Am I selling Tesla? Have I sold Tesla? What am I buying? You get that trading intel, fundamental analysis, short-term, long-term trades. Real estate, you get, if you're looking for your first house, your first rental property, you want to use a property manager, Zero to Millionaire Real Estate. This is how you get the best wedge deals, my opinion. A lot of knowledge in this course. You want to go into managing properties yourself. You don't just get me, you get professional property managers interviewed in this course as well. Some incredible insights to make sure you don't get ruined by tenants. You want to grow your income as a real estate agent, as a social media content creator, or you want to grow your income as an employee or other self-employed person. Check out the Elite Hustlers group. Remember, a lot of these programs are tax deductible. Check with your CPA. You can also shadow me. Now, I don't sell transportation. Remember that you're not paying for transportation. So if you want to come shadow, you got to pay to get yourself out here. Obviously, if I go drive somewhere, you can come with me. It's incidental to what you're paying for. You're paying to shadow me, right? You're not paying for transportation. If we go fly somewhere, then that would be included as well. Now, I want to be very clear. You're paying to shadow me. That should be very obvious. Anyway, with these programs, though, you get lifetime access to all of the new content that's added to them as well. But hopefully you've appreciated this breakdown and take advantage of that 69% off flash sale through Valentine's.
From the desk of the chief economist of Morgan Stanley. In the year ahead outlook, we present our expectation for a soft landing this year with a forecast of just 0.3% real GDP on a Q4 basis. We hardly call for a stellar growth, but foresaw a positive outcome nonetheless. We stood well beyond the more pessimistic consensus at the time. Economists and markets have moved in our direction.
Well, except for Mike Wilson. But basically, they're saying, look,
our conversation suggests the phrase isn't clearly defined. It tends to gloss over policy implications, but seems to most closely resemble a soft landing.
In English, Morgan Stanley, other than Mike Wilson, think we can get a soft landing, which is really interesting because Morgan Stanley's kind of playing both sides here. It's kind of like, oh, we're bulls, but we also have a bear at our company. So like if the bear ends up being right, we could put him on a pedestal. And if our chief economist ends up being right, we could put him on a pedestal. Kind of interesting. I don't have that luxury because I think I'm very transparent and I'm very clear about my positioning. I can't play both sides. Unless, of course, you only read the titles. But if you only read the titles, you're a moron. I think the true people who are here to learn watch the videos, and they watch the majority of the videos and through them. And I hopefully you pick up a lot of info and value. That's my goal, right? Provide more value. And whatever business you're in, if you want to make more money, remember, the number one rule of thumb is provide more value. Do not be a yomi. A yomi is the kind of person that's like, well, you owe me more pay, and maybe if you pay me more money, I'll work harder. No, you're fired. If you're a yomi, you're an idiot. Anyway, that's not how capitalism works. Work hard, then you shall receive. The harder you work, the luckier you get. Hard landing scenario. So they suggest that a hard landing is basically anything with less than 0% GDP. Now, I think that's really interesting. They're basically saying anything hard is a recession. Anything, and that they also call this potentially the Fed over tightening. Anything soft, they actually think is just slow GDP growth, right? Below GDP trend growth, which would be 0 to 1.5% trend growth. Resilient growth, they think, is this no landing scenario where the plane just doesn't come in for the landing, right? And what is the no landing scenario? Well, the no landing scenario is the economy doesn't slow down, but inflation goes back to target. This is a version of the world where potential is simply higher than anyone thought. I include this scenario, however, it's unlikely that it plays out this year, but they're including it to cover a full range of possibilities. So this is really interesting. So Morgan Stanley's basically saying, look, we're not going to get a no landing scenario where a recession or GDP growth is over 1.5%. I mean, I kind of agree. I don't think that the economy is going to grow at more than 1.5%. My base case is the soft landing, right? Is that basically we're sitting, even if we have no growth, it's still not necessarily going to be a recession, or if it's a recession, it's going to be like 0.1%. Like, it's going to be the most benign recession ever. I really don't see this as like an 08. We don't have the massive structural disasters that we have. And it's still possible, even though the word is really disgusting, it is still possible that inflation could prove to be transitory. And that's what I'm seeing in sort of leading indicators from earnings calls from companies. Now, that doesn't mean we won't have a bad CPI read tomorrow. That's sort of a very short-term outlook. But for the next year, I think the trend is very clear, down. So balance of the data coming out is starting to be mixed. GDP and manufacturing data so far are lining up with potentially flat growth, flat GDP growth for the year, which I don't think flat GDP growth is really flat. I think it means no growth. It means zero. Consumer, or rather Conference Board's leading economic indicators, LEI, suggesting definitely a recession within the next 12 months. That's very similar to what Bloomberg says, but then again, it's like, okay, well, how bad is it going to be? You know, is this just statistical noise? Morgan Stanley talks about these indicators potentially just being noise. It's like, okay, well, sure, we've got a really inverted yield curve, but how bad is it going to be? Now, this was interesting because Credit Suisse actually started talking about PP. They talk about this idea that even without a full-blown recession, we could expect corporate earnings to suffer. This is the Mike Wilson argument, right? But this is at Credit Suisse, as much as you could trust them for what it's worth. But anyway, they think that earnings will fall significantly below current consensus expectations. They think that waning growth, here it is, pricing power, and increased interest rates provide an unfavorable mix of factors. I actually agree with this. I think broadly, many of the companies in our indices, especially the S&P 500, are going to see pricing power evaporate. And that's mostly because companies are going to either have to cut prices or keep prices stable in the face of still embers of inflation, which basically means rising costs, which means that these companies take it in the margin, basically. So their margin absorbs some of the pain. And that is generally aligned with a lack of pricing power. Now, don't get me wrong. I think every company is going to lack pricing power relative to 2021. No company is going to have the same PP they had in 2021. You know, they all got a little bit older. Their PP just doesn't function as well anymore now that they're all a little bit older. But there are still some PPs that are bigger and stronger than other PPs. And I think the goal is to find the largest PP in a tough time. Anyway, so big fan of pricing power and finding that. Now, should wage growth remain elevated as PP wanes and gets smaller, you would end up having another drag on earnings. So this is, again, suggesting if you're looking for companies, again, your goal is to try to find the biggest PP. That's a Credit Suisse piece. I'm actually really impressed they started talking about PP because I think it's very, very important. It's actually the first piece I've really seen talk about PP in this cycle. I'm pretty impressed by that. Now, this is interesting. They call the Goldilocks scenario potentially transitory. Here's just another Credit Suisse piece. They do not expect a sustained upturn in some industrial production numbers. And even though we've seen a contraction, we're expecting a rebound. They just don't see that rebound to be very large. Now, what is interesting is they think the impact of COVID-0 going away in China will be relatively limited on inflationary impacts, that maybe there'll be some inflationary push through to European industries like German manufacturing and autos. But otherwise, they say that zero COVID was not a major impediment to Chinese industrial activity. I kind of scratched my head a little bit about that because I do feel like a lot of factories were suffering because of zero COVID and sort of the lockdowns. But they really think the biggest move up is services, which is true. I mean, that's what we're seeing so far in the boom in China is travel and entertainment, much like what's booming obviously over here as well. And they think there are clear risks to see oil over $90 a barrel. But then again, at the beginning of January, everybody's like, oh, oil's going to go to $100 a barrel. And it just like never ended up happening. Who knows? It could still happen. And now I'm starting to see their estimates fall though. Business surveys fallen to levels consistent with a severe slump, and that maybe momentum will stabilize. The Credit Suisse here warning, and this aligns with sort of their small PP argument, smaller pricing power argument. They expect that consumer strength will fade in the months ahead, along with retail sales trending sideways. Biggest risks being furniture and appliance demand as home sales continue to deteriorate, as well as business fixed investment likely struggling. And we do not expect a sharp contraction, though. So again, this is really in line with this idea of like a shallow kind of recession, right? Inventory still pretty high. You saw the same complaint about inventory still being high at companies like Energizer Batteries. This is hitting companies like Target and Walmart and so on. However, you're still understocked in autos. And the argument is that you might be seeing I hate using this word, but potentially a transitory bump in inflation for autos, potentially because of the understocking that we're seeing. They do expect that household consumption in China will improve this year, but again, likely in services, structural headwinds will remain and goods demand will remain below pre-pandemic levels. Part of this is because of an increase in precautionary savings by individuals because of wealth lost thanks to lower property prices. Remember, their real estate disaster was somewhere in the effect of 35 to 40% price declines. So you've got some major hits over there. From China. So emerging markets ex-China, generally people are pretty bullish. However, inflation is still present in emerging markets. So you have to kind of be careful. In Latin America, they think you're still seeing supply side issues that'll really hurt the pace of disinflation. And I see that when I analyze Embraer. I mean, they're still suffering, man, with increasing in prices and supply chain shortages and stuff, which in the short term does give them some more pricing power for selling jets. But yeah, that's oh yeah, and then there's this idea of a vibe session. Okay, I'm gonna be very brief about that. The idea of a vibe session is that basically everybody feels like we're going into a recession, but maybe we don't actually end up hitting a recession. That's sort of consistent with the idea of a soft landing. And I thought it was really an interesting phrase, like really a vibe session. That sounds pretty lame, but okay, I'll address it. So you've got really, in my opinion, if you kind of look at this, like all the sort of more bearish analysis, anything pointing to a recession is kind of like, okay, yeah, earnings are going to go down, but how much? And it's really like, okay, so we might go into recession, but how much? And it's kind of like nominally, like it doesn't really seem like people are really like that worried that this is going to be fall off the cliff style recession. Although who knows? And I think tomorrow's CPI will give us a little bit of an indicator. Yeah, take it in the margin, man. Take it in the margin.